Good afternoon and welcome this afternoon. It is the close of the market. It is Friday. There are the bells telling us that the market is closed. So thanks for joining me. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Brent Moores, who's also an education coach, 20 plus year veteran of the financial markets. He's there to help answer your questions. And I just have to say, first of all, thanks to Brent for helping to cover this particular class and being my partner and compatriot in this as I've been traveling. I'm glad to be back here today, though, bringing the end of this week to you in this market movers discussion. So, welcome to all of you. Thank you for joining us, whether you are in the live version or the recorded version. We are glad to have you here with us to close out the week. It's been an interesting week, as we often say. Here in this discussion, having a little bit of bandwidth issue at the moment, so that's why we turned the video off, just so that you're seeing my picture there. Otherwise, you'd be seeing my Astro-splosion Thinkorswim splash Hawaiian shirt today, but that's okay. I've got my tasty beverage here ready to go, and we are ready to talk about what's going on in the market. A couple of quick housekeeping items, though, before we get started. Everything we talk about simply for illustrative and educational purposes only, not any kind of a recommendation or advice. Remember that any of the individual symbols that we look at are for illustrative and educational purposes only. We're not going to talk about options in this discussion, but if you do happen to see option content in the discussion, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. We're going to be using the Thinkorswim desktop software platform today. It is not a guarantee of future success out there in the real world, but it is a great learning environment. We're going to be using specifically the paper money version of the platform. So as we do that, again, yep, I've done that. Okay, so double check, make sure that we're on that. Hang tight, guys. We'll catch up here in just a second. Yep, I've paged forward. So I'm sitting on the disclosure slide. Worries. All right, we're jumping back in here. Thanks to our great production staff, Andrew, today, that is helping to bring this content out to you. Appreciate your patience during the brief technology issue, but we are back on track. Again, just that quick reminder, everything we talk about simply for illustrative and educational purposes only. And the paper money platform, great learning environment, not a guarantee of future success out there in the real world. Remember that there is risk involved in trading, including the loss of principal. So let's jump into this discussion here really quickly. I'm going to change the stream here to our Thinkorswim desktop software platform, the paper money version. And we'll make sure that we've got that changed. Okay, looks like we're looking at the right chart here as well. Villager, thanks. I take that as a compliment. Sit back, relax, and we're going to spend a little bit of time looking at what's going on in the market today. Taking a look at the SPX over the course of the last week, one of the things that I happened to notice is it was pretty quiet, despite the fact that there was a lot of movement, not just necessarily not happen in price. There was a lot of volatility movement. There was a lot of data. There was a lot of news that came out. For a big news week, it was a small week price-wise. And so we take a look at the week-to-date change here on the S&P 500, and we were just down a little bit over the course of the week, right? So net down about 0.5% for the week, which is pretty significant given the fact that, we've seen some weeks that have had some pretty significant moves to the downside. That's the S&P 500. The NASDAQ down only about 2%, or excuse me, 0.2% over the course of the week. More importantly, I think running up into that 50 period and that 200 period moving average, kind of the in-between median or no man's land, if you're from New Orleans, that intermediate area in between the 50 period moving average and the 200 period moving average, kind of that area where those two moving averages have been acting as a bit of a support and resistance area. But some pretty strong momentum indicated by the RSI, kind of giving us the idea that there is still some bullishness at foot. And the Russell 2000 breaking up above the 50-period moving average, nowhere near the 200. It hasn't been near the 200 since about the February timeframe, where it crossed down through that 200-period moving average from top to bottom, so crossed below it, and it stayed below it. However, there is kind of this major level of support right around this 1990 mark, 1991. And that area, which coincides with about the 50-period moving average, seems to be acting as a bit of a support level. We see a little bit of a bounce. On the week, this is the only of the three indexes, the three major market indexes, that is up and positive, so up 0.12% on the course of the week. But it certainly seems as if RSI kind of going sideways. We saw a little bit stronger movement today, from a gap up sell-off perspective, yesterday from a gap up rally perspective in the small caps. And that's not necessarily all that unusual, given the fact that small issues maybe a little bit more quickly than other parts of the market. I want to switch over here really quickly to the, let's see if we can pop back over here. And I'm going to jump in really quick to the Schwab.com website. And it timed out on me while we were waiting for that, but I'm going to jump right back in here quickly. And I want to go to the research section of the Schwab.com website. I want to come down here to U.S. markets. And in U.S. markets, I'm going to come back down here and we're going to take a look at what has gone on over the course of this last week. So I'm going to come over to the right-hand side where it says calendar. I'm going to click on today's events. And we're going to take a look at what happened over the course of this last week. So economic events over the course of this week. This has been a pretty big week, right? So taking a look at the beginning of the week, on Monday, we had ISM services numbers, which were a little bit stronger. Remember, on these ISM numbers, manufacturing or services above 50, above that 50% level suggests that that part of the economy is expanding. Below 50 suggests that that part of the economy is contracting. So the forecast and the expected range and the prior range were all in the 50.2, 50.8 range. We in fact saw pretty hot services numbers in that ISM number, suggesting maybe there was a little bit more kind of an expansionary mode. Same thing with the PMI, although the prior number, and again, the PMI number is subject to some revisions, but still in expansion mode. We saw trade balance numbers, and obviously this is one that is going to get pretty heavily slammed given tariff issues. That's gone back and forth. We've seen changes to that trade balance, but of course that is subject to revisions as well. And we get to Wednesday. Wednesday was the big day as far as news, the granddaddy of them all as far as economic numbers, and that is the FOMC meeting. And it was pretty much a little bit of nothing and was expected, right? The market expected, and most investors, institutional and otherwise, expected that the Fed was really not going to do much. In fact, they just left things alone. But the statement, the press conference, came out with some new language which suggested that there were potential risks afoot. I mean, we've heard it. We've heard it in social media and news and everywhere else that there are possible risks to the economy coming from tariff issues. And finally, the FOMC and the Fed chair are reflecting that as well. So not really a market mover, but it did seem to diminish volatility overall somewhat. Crude oil inventories down a bit, although not down as much as were expected for the demand destruction of crude oil in just a minute. But you had some things like consumer credit. You had mortgage applications that were up a little bit higher. You had continuing claims that were a little bit lower. You had initial claims that were a little bit lower, so suggesting some stronger labor numbers. And you had labor costs that were increasing a little bit, which is expected, right? But all of those concerns kind of circle back to what the Fed said. And the Fed said, hey, there are potential indications of what is referred to as stagflation. Stagflation meaning inflationary pressures are not easing, and labor is not catching up to that inflationary pressure, meaning you don't have wage growth, but you have inflationary growth, and you have a declining GDP. So those are some of the things that create stagflation. That can be a concern, and that's what the Fed kind of pumped into the mix. But if we pop back over here to the platform and we take a look at what's going on in those major indexes, they didn't really move very much on that stagflation issue. But what did move a little bit is the volatility index. And we come back over here to the VIX. And this is kind of the key point that I want to talk a little bit about. Volatility at the moment, given all of the swirling concerns about everything that's going on and the possibility of change, and we saw tariff deals being announced and not being announced, and all of that uncertainty seems to be digested by the market pretty quickly. And that's an indication of what's going on here with the VIX. The volatility index, kind of the proxy for how the market is taking this information. All right, hang on. It looks like we are stuck. All right, looks like we are stuck at the moment. Let's see if we can pop this loose and see if we can get things going a little bit. Stand by. Okay. There we go. Now it seems to be catching up. Cool, cool. All right, now it seems to be catching up. All right, thanks for your patience, guys. I appreciate you sticking around, sticking with me. We've got a couple of more things to cover as we wrap things up here this week. But volatility falling, kind of coming off a little bit and settling back. We didn't see a big spike in volatility. It's well below its 30-period average. So volatility kind of easing off just a little bit. Now, one other thing that I wanted to bring into this mix is this comparison here. And let's see if my chart will catch up to that really quickly and see if we'll see the change going on here. I'll wait and see if that chart changes for us. And if it doesn't, we'll move on. But one of the things I want to talk about, if you're still hearing me, despite the chart not changing, is the fact that volatility is relatively cheap at this point. The VIX is higher than the VVIX, and that would suggest that institutional investors primarily are not pushing protective products. They're not buying volatility products to hedge downside movement. That's typically an indication of kind of a lack of fear in the market, if you will. So one of the ideas with this, when volatility is low, it kind of goes back to the idea that when volatility is low, it's like buying an umbrella when it's not raining. That when it's not raining, umbrellas are cheap. And when it starts to rain, if you bought a cheap umbrella, you feel good about things. But investors, institutional investors, not really pushing prices on the VIX at the moment. A little bit more complacency, if you will, at the moment. So something to think about in terms of that perspective. Now, the last thing I want to look at here really quickly as we kind of wrap this up into this discussion is this. I'm going to come back down to my S&P sector grid, and we'll see if this will catch up here in just a second. Again, thank you for your patience as our charts catch up to the audio. Let's see if we can force that a little bit. It seems like we're streaming pretty well now. We'll see if I can stop and then restart that audio stream, or excuse me, the video stream here. All right, looks like we're back. Sorry about that. Again, thanks for your patience as we work through some technology challenges. So, going back to answer a couple of questions, VIX versus the VVIX is the comparison that we were looking at before. VVIX is the volatility of VIX. So VIX relatively cheap. But now what we're looking at is a sector grid of all 11 sectors in the S&P 500. And I kind of wanted to look at just simply what is reacting as this market is starting to perhaps move a little bit higher. And as we can see, so the blue line that you're seeing in each one of these cases is the 50-period simple moving average. That 50-period simple moving average in this particular case seems to be moving to the downside. And we see a number of those sectors: energy continuing to move down, materials continuing to move down, discretionary, so discretionary retail still moving down. In fact, even staples starting to roll off a little bit. That might be a key. Healthcare, in this case, though, continuing to move down. Financials continuing to move down. Utilities staying relatively flat, which is not at all uncommon in times like this when there's some uncertainty. Real estate moving down. But there are 2 points that I wanted to take a look at. One is what's going on with information technology, the technology sector, and one that's going on with industrials. So I want to look at industrials first, and I'm going to expand this cell. So what do you see in industrials is the fact that industrials, let's see if my chart will catch up here quickly, that industrials have been continuing to make this move to the upside for the last month at least, right? And we've been seeing this upward rally in industrials. That perhaps suggests some pull through on the part of industrial manufacturers in terms of tariff impacts, front running that tariff impact, and also changes to their inventories and margins. But it also reflects CapEx spending, capital equipment spending in the industrial sector. That would also suggest that maybe there is some more onboarding of manufacturing capabilities within the US, and industrial companies are rotating to that idea. They're spending more to get ready for that possibility. The other idea in this particular case, and let me close this down and we'll come back to our grid, is what's going on in information technology. And if we open up information technology, this was probably the first and hardest hit of the sectors when things started to rotate back down to the downside. We started to see some of the tariff issues hit. We saw that rotation in February and March moving back down to the downside. Now, though, we've seen it break above the 50-period moving average. We've seen information technology starting in terms of that 50-period moving average turning back up a little bit with some regaining of this leadership. And if information technology is regaining that leadership, that might be an indication of why we're seeing some rotation out of staples into things like information technology, into communication services, into semiconductors, into manufacturing, into industrials, away from the defensive sectors. So that's typically the flow of money into defensives when things are uncertain, when uncertainty starts to pass, which it inevitably does, then back into some of the leaders, including technology. And so that tends to be the relationship, right? So as we start to see that happening, that leadership gains strength in areas like technology. Now, I want to answer Sonny's question, and in fact, that is exactly where we are headed next. And the question was this: where do we see the market movement relative to the components of the market and how those components are doing relative to their relevant moving averages? So Sonny asked the question, how do you see the number of stocks above a particular moving average, and how do you plot it on the chart? And I've done exactly that here. So here's what we're looking at. This is a plot and a comparison chart of three segments of the market. it is the segment or the percentage of the stocks that are above the 200 period moving average. It is the percentage of the stocks in the SPX that are above the 100 period moving average. And it is the percentage of stocks in the SPX that are above the 50 period moving averages. Brent put the symbol for the 200 out there. It is $SPX A 100R or 50R or 200R. Those are the symbols that get you those lines. You can put them on a chart, in a comparison chart. I've got these on the comparison chart, and this is what's interesting to me. And what I think is kind of really starting to stand out at the end of this particular week is the fact that the percentage of stocks above their 50 period moving average is really now, in this particular case, in this first week of May, starting to move above the total of the SPX. Now, what that suggests is that that percentage, if we were to look at it in absolute terms, is about 12% of the SPX. That says, hey, a growing segment of the S&P 500 has now recovered price above that 50 period moving average. A smaller percentage is above the 100 period moving average, and a smaller percentage still is above the 200 period moving average. But the lines are moving in the right direction to become more bullish. So as we start to see these percentages turn and continue to rise, what you're next likely to see is that the number of stocks in the SPX moving above the 100 period moving average may begin to grow. Ideally, these are going to stay, if we're bullish, these are going to stay in line with one another. See the percentage above the 50 more so than the percentage above the 100, more so than the percentage above the 200. When the market starts to turn bearish, that's where you're going to kind of start to see that reversal. And we see that back here in December, where it lined out that same way. 200, 100, 50, but then it reversed itself. The number below or above the 50 started to drop. The number below or above the 100 started to drop, and you see this reversal. But this is where we start to get this turn back here in April, where everything started to rally, and now we can see that there's some leadership gaining strength again. And this could be a strong indication that as these percentages start to grow, yeah, these are daily numbers. As these percentages start to grow, that's an indication of strength in the market or breadth in the market. You might think about it from that standpoint as well. So we start to see these numbers grow into 20, 30, 40% of the stocks within the SPX that are above those moving averages. That can be a stronger indication of bullish movement. So the last thing I want to do here really quickly as we go back into this discussion is I want to jump over here to the Market Watch tab. And in the Market Watch tab, I want to go to our calendar. And I want to take a look at next week. Because next week, let's see what we've got coming up. This is, again, on the Thinkorswim platform, another place where you can start to see some additional information. So we've got Treasury auctions. We've still got a bulk of earnings announcements coming next week. That's where you see those telephone icons there. But you're also going to see a lot of Econo Day, these Econo Day events coming up. So we've got a number of things that are happening next week. We've got CPI, we've got GDP, we've got CPI final numbers, got some PPI numbers. So we've got some data points that could potentially move the market. We're through the bulk of a lot of the big tech name earnings, but we do now, as we get into this later portion of the earnings season, get into things like some of the luxury retailers. So watch for impacts to the stocks in the discretionary space that may have the potential to be impacted by tariff news and impacts in that rate. Our producers are starting to are trying to work on that, Lawrence. So stick with me for just a second here. All right, there we go. Now we should be on the calendar. Good. Okay, now we should be on the calendar. And again, you can see we're looking at next week. And this is the Market Watch tab and then the calendar. And then we're looking at next week's calendar. You can look at last week's calendar here as well. You can go back to the Schwab.com website and you can look at the calendar there. But this is a great way to kind of see what is over the horizon or what is behind us in the rearview mirror at the moment. And you can see that we still have a couple of days where we have upwards of 200 earnings announcements coming up Monday of next week, Thursday of next week. So there's still a lot of market to be had. But the next thing I want to do here really quickly as we round this out is I wanted to point you to a couple of resources. And as we go into this weekend, it's Mother's Day weekend. We hope that you have the opportunity to spend time with loved ones. But if you have some time, it's a great opportunity for you to spend a little bit of time here in the Trader Talks webcast page. We ask you to click on the subscribe button right there. That's going to help to give you easier access to the content. It's also going to pop this content up for other people as well. Click on that subscribe button. Click on like if you liked this webcast. But this is where you go if you've got a question about a particular topic. Join us right here in these Trader Talks webcasts in the recorded versions. We teach 30 plus webcasts a week, and we record and archive all but 2 of those. And if you are out, I know Brent mentioned this a little bit earlier, but if you are out on the road or you have the ability to travel, we've got a couple of things coming up that I just wanted to point out. We go to the in-person events page. Coming up at the end of May in Anaheim, we've got the Advanced Options Strategies live workshop. Coming up in June 13th, we've got our first market drive for the year in Miami, Florida at the JW Marriott Turnberry, which is a beautiful property. Then coming up in June, at the end of June, we're going to be at the Marriott Marquis in New York, right on Times Square. We're going to be doing another market drive event. And then if you're on the West Coast and you can join us, we're going to be doing a technical analysis and option strategies workshop the 11th and 12th of July in Santa Clara. And then coming up in August, we're going to be doing another technical analysis and option strategy workshop back in New York. So we're going to love seeing you at any and all of those locations. You can just get a VW microbus, paint candlesticks on the side of it, and just follow us around as groupies to all of these events. We'd love to have you do that as well. Guys, thank you so much for joining me. Once again, my thanks to Brent Moores for helping out not only in the chat today, but also in the previous weeks in helping out with this particular presentation. Guys, I've said it before, and I've told you this a number of times, the idea of why we do all of this is because it helps us to be better educated and better informed investors. It helps us to make better decisions. So there's some reasons to do all of these things, to jump into these webcasts, to follow us on our live events, to join us for events like this. We appreciate you being here. And so I'm going to sign off the way I've signed off for our events on Friday afternoon for a long, long time. Keep your arms and hands inside the ride at all times. Hang on and have fun. We'll see you next week. Take care, everybody. Bye-bye.